All right, everybody, welcome back for another deep dive.
It's great to be here.
We love to look at these big stories in finance, and we've got a big one today with Generali and Natixis.
Definitely a big one.
Merging their asset management arms. And so obviously this is a huge story in the investment world, but we always try to bring it back to what does it mean for our listeners?
Exactly.
So that's kind of the mission today. So
yeah, absolutely.
Let's jump right in and kind of set the stage. Generali and Natixis, huge names in finance and insurance and all sorts of things. But this is specifically their asset management arms. So when we say asset management, we're talking about
managing money for people, for companies, for institutions,
pension funds, all sorts of stuff, right?
Exactly.
So those arms are coming together to create this behemoth with something like $2 trillion.
$2 trillion with a T.
In assets under management.
Yeah.
It's mind-boggling to even think about a number that big. But
it's hard to fathom.
What does that actually mean?
Yeah.
I mean, for people who aren't in the investment world.
So putting that into context, $2 trillion puts them, easily in the top 10 globally in terms of asset managers.
Wow.
You're talking BlackRock, Vanguard names that you probably have heard of, even if you're not super into the investment world.
Yeah, so those are like the Coca-Colas and the household names.
McDonald's of the investment world.
Exactly, and that's kind of the trend that we're seeing in asset management, this consolidation where these bigger players are just getting even bigger.
So why is that happening? Is it just
Well, there's a few reasons. One is definitely economies of scale.
Okay.
When you're bigger, you can spread those costs out.
Yeah.
You can invest more in things like technology.
Sure.
Offer more diverse products and potentially get better deals for your clients.
Yeah, that makes sense. The bigger you are, the more
leverage
you have, the more power you have.
To kind of move things around and get the best deals.
Absolutely.
But it's not just about size. It sounds like they're being really strategic about this too. They're setting up their headquarters in Amsterdam.
Yeah. Interesting choice, right?
Which seems kind of random.
Yeah.
But they're also going to have these big operational hubs in France, Italy, and the U.S.
They're covering their bases.
Yeah. So, and if you break it down geographically, it's 61% of their assets are in Europe, 34% in North America.
Right.
So what do you make of that kind of global footprint?
Well, I think it speaks to a couple things. One is diversification.
Okay.
Not having all your eggs in one basket. Geographically speaking, Europe offers stability and familiarity. But North America is this really dynamic, high-growth market.
So they're kind of getting the best of both worlds.
Exactly. Trying to...
Stability and kind of...
Yeah, a little bit of spice.
Yeah, exactly. Yeah. High growth.
And also, it allows them to navigate economic headwinds a bit better because if one region's struggling, the other might be doing well and vice versa.
So it's kind of like hedging their bets, but on a global scale.
Exactly.
Okay, that makes a lot of sense. So let's talk about the actual investments. This $2 trillion pie. How are they planning to slice it up?
Yeah.
When I look at the numbers, it's about 65% fixed income, 21% equities.
Okay.
And then the rest in private markets.
All right.
So what does that tell us about their overall strategy here?
So fixed income being the biggest chunk that suggests they're aiming for stable, predictable returns.
Okay, so kind of the safer bet.
Yeah, the foundation.
Yeah.
But then you've got that 21% in equities, which is stocks.
Right.
That's where they're hoping for higher growth potential.
Okay.
And then the private markets, that's the really interesting part because that's where you get into things like private equity, real estate infrastructure.
Okay, so that's the higher risk, higher reward kind of stuff.
Exactly.
Okay.
And remember, Generali is pouring 15 billion euros specifically into expanding their private assets portfolio.
15 billion. That's another one of those numbers.
A big chunk of change.
It makes your head spin.
Yeah, and it shows they're serious about this.
Wow.
It's not just dipping their toes in the water. They're diving in head first.
So it sounds like they're playing it safe with that fixed income, but they're also willing to take some risks.
Absolutely. It's a balanced approach. You need that solid foundation, but you also got to be willing to swing for the fences sometimes if you want to hit those home runs.
Makes sense. Okay, so this all sounds very exciting,
Yeah.
Big numbers, big plans. But this isn't happening overnight, right?
No, this is a long gap.
We're looking at early 2026 for this to be finalized.
Yeah.
What are some of the challenges that you see as they try to pull this off? Merging two massive companies.
Oh, there's going to be hurdles for sure. First off, integrating all those systems and processes from 2 different companies, that's a massive undertaking.
That's got to be a nightmare.
Yeah, and then you've got the cultural aspect too, bringing together 2 different company cultures.
2 different sets of employees who...
Exactly, who might have different ways of doing things.
Right.
And even different investment philosophies.
Yeah, that's got to be a big one.
Huge. And, there's always a risk of key personnel leaving during a merger like this.
Oh, yeah, people get nervous.
Yeah, they start looking for other opportunities.
And then just the regulatory hurdles, too, right? I mean, get all the approvals and everything.
Governments are going to want to scrutinize a merger of this size.
And that takes time.
Definitely.
So even if everything goes smoothly, which it never does, it's still going to be years before.
Yeah, this is a marathon, not a sprint.
Yeah, and even then, achieving those economies of scale that we were talking about earlier, that's not guaranteed.
No, it's not. And any hiccups along the way could impact their ability to deliver on those promises.
To their investors.
Exactly, and their clients.
Right, to their clients.
Right.
So let's say they do pull it off.
Okay.
What could this mean for the average investor out there?
Well, potentially, it could mean a wider range of investment options at lower costs.
Okay, so that'd be good.
That's the hope. But on the other hand, you also have to think about the potential downsides.
Okay.
Like less competition in the market, which might not always be beneficial for investors in the long run.
So it's kind of a double-edged sword.
It is. It really is. There's no easy answer.
Yeah, I mean, that's the thing with these big mergers.
Right.
It's hard to predict all the ripple effects.
Absolutely. It's like watching a giant chess game unfold and you don't know who's going to win.
Exactly. Well, this has been a fascinating deep dive, I have to say.
A lot to think about.
Yeah. So just to kind of sum it all up, we've got this potential titan emerging, from this Generali and Natixis merger. They're aiming for global dominance.
Right.
They've got this really carefully balanced portfolio.
It seems that way.
And they're basically hoping to reshape the financial landscape.
We'll see what happens.
We'll see what happens. And that's the thing to remember, folks. This is all still unfolding.
Very much so.
So, is this a sign of things to come? Are we going to see more of these mega mergers?
Yeah, it's a question.
In asset management and beyond? Something to ponder?
A lot to ponder.
As you kind of look at your own investments and you think about the future of finance?
Yeah.
So thanks for joining us on this deep dive.
My pleasure.
And until next time, keep on learning, keep on exploring, and keep on diving deep.
Absolutely.